Hey everyone, Derovic here, Forex trader, coach and mentor. In this video I want to share with you the 10 successful principles that most successful or profitable traders share. The first one is they let their winners run and they cut their losers. What this means is when they're right about the market, they look to stay in the market as long as possible, extract as many pips or as much percentage return as they can. And when they're wrong about the market, they look to cut it as soon as possible. This also goes hand in hand with a positive, risk-reward ratio, where the risk is a certain percentage and the reward is a multiple of that percentage. So what most unsuccessful traders do is they do the opposite. They let their losers come back to break even so that they don't feel like they're losing a trade. They have a negative association to losing trades, and they cut their winners short. So as soon as he goes into profit, they look to grab the money and they look to get out of the market. So that's not what the profitable traders do. And if you find yourself doing that, then you might need to review what you're doing and maybe change the path a little bit. The second successful habit that they incorporate is they don't care about being right about the market. They don't have to be right all the time. They care about making money in the market. That's much more important than being right. It's like the best-selling author T. Harv Eker says, you can either be right or you can be rich. It's always your choice. So know that you don't have to be right in the market all the time in order to make money. The third point is that they make their decision before entering a trade. For example, they know where they're going to enter, they know where they're going to place their stop loss, and they know where their target is before doing anything in the market. Once you enter the market, you can be influenced, or it's much easier to get influenced by the sways, by the moves of the market. If you make your decision prior to entering the market, there is nothing that can sway you either way. You've made your decision, you've entered the market, and that's it. You're just waiting to see whether you were right or wrong, whether you're going to make money or not. That's it. There's nothing else to it. The fourth successful principle is that they think in probabilities. They will have losing trades. It's nothing personal, it's just part of the game. They know that out of a sample of 100 trades, they're going to lose 20, 30, 40, whatever the number is. But they think in probabilities. So if it's a winning trade they've just experienced, they've expected it to be a winning trade. So they're not happy about it, they're not sad about it either. But they're not running around and, it's not going to change their life. They're thinking in probabilities. Also, when a losing trade happens, they're not sad, they're not angry, they're not fearful. They expected that out of those 100 trades that they're going to be taking, some of them are going to be losers. They've accounted for them and they just carry on executing further trades. The fifth principle is that they execute trades with confidence and conviction. Number 5, they execute trades with confidence and conviction. They don't hesitate, they don't second guess. There are no conflicts in their head about taking the trade. If they get the setup that they're looking for, they will execute it without any conflicts, with confidence and with conviction. Number 6, they never, ever, ever add to losing positions. They only add to winning positions, and once a position starts working in their favor, they can keep on adding positions, scaling in, and creating a larger position to profit from. However, if they are wrong about the market, as I said earlier, they try to cut it as soon as possible and look for other trading opportunities where they have a better chance of being right about the market, and then maybe accumulating a larger position in a different sort of trade. However, they never add to losing trades, and this is something that break-even losing traders or consistently losing traders do. They try to redeem a losing position because they don't want to lose. They're trying to avoid a loss. So they add to losing positions, and then they just end up with a bigger hole to dig out of. So that's a ticking time bomb. Don't do that, and focus on adding to winning positions and cut your losers as quickly as possible. Number 7, they have developed the ability to sit on the fence and not do anything if the market is not clear to them. So they don't feel that they have to be in the market constantly. And this also comes down to the link that most of us have. And we have this link because of society around us, because of school programming, etc., etc., etc. So this link is the time and money link, where we as people believe that the more time we invest in something, the more money we'll make. Well, trading doesn't actually work like that. It's actually the opposite. The less time that you are in the trades, and the more of the bad trades that you avoid, the more profitable you will be. I know some very successful and profitable traders that only take a couple of trades a month, and that's because they've found a very high quality and high probability setup that they look out for, and it usually comes along once or twice a month. They take this setup and they're done. They've made their 5, 10, 20% in a month with one single trade, one good high quality trade. So the fact that you might be trading a lot, intraday, taking 10, 20 trades in a day, does not make you a highly profitable trader. It generates a lot of commissions for the brokers, maybe even for yourself. However, it's very important to know that when to stay out of the market. And highly and consistently profitable traders, they don't trade when they don't see a clear picture. So that comes down to the discipline as well, and don't take this point lightly. I think it's very important to know when to stay out of the market as well as when to be in the market. So take some time and look at this point. Number 8, they see themselves as the casino. They see themselves as the market maker. This actually puts control in their hands rather than control in the market's hands. What this means is basically it's a different frame of mind, it's a different way of thinking, where you are basically waiting for your setup, and when your setup arrives, or when your trading signal comes up, you know what the probabilities of your trading signal working out are, and that basically puts the odds in your favor. So in this case, you are the casino, the odds are in your favor, and you're entering the market at your own terms. So a lot of the profitable traders that I've spoken to, that I've met as well, have this sort of casino or market maker attitude towards the market, where they're offering their money to the market at particular odds, and if it's not there, they're just not engaging in it. They're just waiting for the right setup to come along. So they see themselves as the casino or the market maker. Number 9, they buy in strong markets and they sell in weak markets. So what that means basically is if it's a bullish market, they wait for retracements to occur. Once the retracements occurred, they buy it and they continue together with the trend upwards. Same thing in a down market, in a weak market or a bear market. Once it retraces slightly, they can continue selling and continue with the trend, and continue making profits in the way that the market is heading. So they buy strong markets and they sell weak markets. And number 10, they review their trading performance at regular intervals. Whether it's daily, weekly, monthly, quarterly or yearly, they still review it and look for reoccurring patterns of maybe mistakes, whether they're technical or within the executing their trades. So there could be mistakes on both the technical side as well as the execution side too. They look for patterns of behavior where they've made the mistakes. They look at possible solutions. They also look at how their strategy has been performing now as well as before, whether they need to make any adjustments. And it's continuous work in terms of redefining their edge and keeping a step ahead of the market. So I hope you've enjoyed this video and these 10 successful principles of profitable traders. Please subscribe to my channel if you haven't already. I'm Derovic, and I look forward to seeing you in the next video. Take care.